Now, everybody, welcome to another edition of Your Money Radio. Let's see here. Danny Storehunter, Bazingo, Don Vanderboard, Alex Katutis with us live whenever you're hearing us. We are live with you right over your shoulder, Daniel, helping you out. Danny, you got a haircut. I just noticed that.
I did. I look good, don't I?
You go to our guy up at the Lucky's. Yeah, Lucky's Barbershop in Dallas. There you go.
You paid too much.
No, he's actually, the price is right.
Let's see here. A lot to
My
discuss.
mom watches that every day at 11 a.m.
Great show.
Carrie. The price is right.
Hunter, where are you? Where are you, brother? Where are you? You're not in Florida, are you?
Yeah, I am. I'm in Jacksonville. I moved apartments, so you got a different backdrop now.
Oh, you moved apartments? I hate moving. I despise moving because I'm a hoarder.
It was brutal. Like me and Nicolette pretty much did it all ourselves, and our old apartment has an elevator. Our new one does not, and we're on the 3rd floor.
Oh,
it was rough, but we're moved in now, and it's like double the space, so we're very happy.
I thought you were heading home to go see me, mommy.
None of your friends showed up to help you move.
I hate asking people to help, so I just go full workhorse mode and just
get it done.
All. Yeah.
I thought you were going home to help your brother or celebrate your brother.
My youngest brother graduates from high school on Monday, so I'm leaving tomorrow, and I'll be visiting with me, mommy, and the rest of my family, and kind of celebrating him getting done and
I'll tell you what,
college.
Hunter's younger brother is a rocket scientist. That's like no joke. That's what he's going to school for. It's pretty cool.
Yeah, he's a smart kid. Loves to.
Congratulations to your brother. Let's Danny, I don't know if you've been following. Well, Hunter, you know what? This is actually up your alley, sort of. Did you follow what happened to Target the other day with sports cards?
Dude, I almost asked you about the whole Target ordeal and them limiting the card stuff and Panini's response, all that stuff.
They've stopped selling cards. So this is all leading to today's discussion, folks. So, and I got to tell you what, if you just hang with me a few minutes as I ease into the show is going to get, at one point, I promise you the show will get dry, but I'm going to make it relevant so you can actually trade against the information to which I present to you, just like last week. Danny, I almost didn't want to do a show this week because I didn't think I could top last week's performance. But we get another opportunity to practice and try again here. So Target, if you're not familiar, folks, stopped selling sports cards. So I don't know if it was the stock person. So they farm all this out. The stock person is Excel Brands, or the stock company that takes the sports cards to Target or Walmart, and that's how you get the retail packs there delivered. I don't know if it was a customer or if it was the Excel stock person, but some guys in Milwaukee or Wisconsin beat up and started to hold up a guy with sports cards in a Target parking lot. And the only thing that chased these guys off, I mean, and the age ranges of the guys beating the dude up were 24 to 34. Like these are grown men. So it's not a bunch of 12-year-olds, running around in a motorcycle gang. These are real dudes holding up a dude in the parking lot at Target for some stupid sports cards. And the only thing that broke it up was a gun. And luckily the fella had a concealed carry permit, and he was able to save himself from really serious bodily harm over some sports cards. And this is not a gun discussion. This is not a sports card discussion. This is an inflation discussion. And it got me thinking when I saw the news about Target. I see trucks rolling down the road when I drop the kids off to school, because like Texas is just one big construction site. Is it like that in Florida where you're at, Don, in Jacksonville, where everything's being built? Yeah,
absolutely. Yep.
And so there's a Facebook group I belong to with the town that I live in. Pardon me. And every now and then someone will take a picture of a lumber truck and go, there goes $1 million truck. And it's honest to God, it's the truth. Because if you look at the price of lumber here, and we'll just pull up lumber, even though it's pulled back slightly, it's really not that much. Down 4% today, but geez, down 4% after an incredible move is, it's like spitting in the wind. So when you look at lumber as this hot commodity, almost to the sense of baseball cards, when do the lumber trucks start getting hijacked? There's always been theft on construction sites, but usually it was for tools. Now you can't get cement, you can't get bricks, You can't get lumber. Went looking at homes last week, and to get one built, it's a 9 to 12 month wait just for some of the supplies. Like if you sign a contract now, Daniel, out here in where I live in Texas, you can hope to move into it a year from now. And it's all based on availability of labor, availability of supplies, because they're backlogged on brick. They can't get enough brick into this country right now. And it's the same thing with semiconductors. And we've talked all about this. And there's a couple ways to ease out of this. Well, with lumber, there's a couple ways to ease out of this. One, you just got to give it time, right? So time should heal all wounds in regards to a supply shortage, meaning that more people go back to work. Maybe they remove that federal boost of unemployment, or it just expires, I believe, September 4th after Labor Day. And more people will want to join the workforce. But you know, where are they making brick? Where are they getting lumber from? Well, if you know about lumber, a lot of our lumber comes from Canada. And so if President Biden called up Trudeau and just said, hey, we're done putting tariffs on lumber, that might get the price down, and that might grease the skids to get more lumber in this country and increase the supply. Typically leads to an increase in price, even though the demand is most certainly there. It's not going to fix it overnight, but I do think it would most certainly help. But Daniel, we've got a bigger issue facing this country, and that's inflation. And we've been talking about inflation for, I feel like, about 2, maybe 2.5 months. And the report that came out this week, the CPI data, is something that I think you need. If you haven't seen, I think everyone's seen it, so I'm not going to bore you with it, but I'm going to make this very relevant for you. If you look on my screen here, and you can see Consumer Price Index, which measures, a lot of people don't know what it measures, and a lot of people don't realize that the number oftentimes that's being reported on the news excludes volatile food and energy prices. And as we talked about last week, you've had this major increase in food, and I don't know why it's doing that, food and energy prices. But I want you to just look at this. Consumer Price Index, basket of goods, as well as energy and housing costs rose to 4.2% from a year earlier. Expected 3.6. The month-to-month gain was 0.8 against 0.02. And what I want to do is I want to write a number on the left-hand side of your screen here, 0.7. And now let me just take a break, because Danny, at the Professional School of Broadcasting that I went to above the CVS in Connecticut, the thing here is, when you write a bunch of numbers on a screen, you lose people. It gets confusing. And what I want you to walk away with here, like whatever you're looking at, stock nerds and market lovers, all of these numbers in terms of inflation are greater than the monthly reported 0.7% increase in wages for the jobs report that was just reported at the beginning of the month. And there's not enough work hours to make up. So the work hours increased and the wages increased, but they're not going up high enough to stave this off. And that, my friends, is what you call a problem. So, well, what do you mean a problem? And well, with energy going higher, and let's exclude the pipeline attack, just the cost of gasoline since President Biden took over is up on average about 54 cents. That's a big increase, because that is a tax against everybody. And so it doesn't, like, people have there is a movement afoot in this country to tax what some people, you know, whatever the perception of wealthy is you have, there is a movement afoot to tax those people. The taxes right now, and there's been no monetary policy, there's been no fiscal policy changed, but taxes have officially gone up in this country in 2021 in terms of the price of food, in terms of the price of energy. And if you're like, well, Tim, what does that have to do with me? Well, like if you take heating oil, and luckily we're coming out of winter, but look at the increase in the price of heating oil, and you're like, well, Tim, that's now, but like just look at this year, this tax. I mean, look at heating oil since Biden got elected. And so let me just make that a little bit smaller, and I apologize because I think there we go. So when you look at this chart, here's where right in the election time frame, and look at this run that heating oil's had So it's not a tax that's just taking place right now, stock nerds and market lovers. These effects of what could be fiscal policy decisions, what could be decisions made by a new Congress, a new administration, are already taking into effect. And so when someone like myself or Danny, Don, Hunter, Alex mentions that the stock market's a forward-looking vehicle, that the market's looking forward 6 to 8 months in advance, that rise in heating oil, even though fuel prices were still not where they are right now, everything was in motion. And that's the whole beauty of the markets, meaning it's a forward-looking vehicle. And so, Daniel, now, as you like to say, it's a Hobson's choice that the Fed has. I've got a systematic way. Look, folks, I've got what I want to do is present this in a clear, coherent manner. And because I think unless commodities come down, this is a lose-lose situation that the Fed's in. But I don't want to just say that anecdotally, Daniel. I want to talk about this, and I want you to understand what's going on. So how does the Fed get inflation? Like Tim, can you prove to me a little bit more about inflation? I missed last week's show. I showed you lumber. I showed you heating oil. Let me show you feeder calf, right? I think that's GF. So look at calf. They're limit up today. Look at the price is going up for feeder cattle, Daniel. Okay, so that's one. How about copper? HG, and copper is unrelenting here. Okay, like I'm a fan of wanting to buy the dip in copper, and I'm not getting a pullback to the mean. You got to pull back here in the middle of the month, but I'm not getting one again right now. And so there is rampant inflation right now, and it's not out of control per se, but let this go on the way it is as we hit peak driving season, as we traverse down the road with people trying to move for the summer, because summer's a busy moving time. And I think you're going to run into an issue. There's a way the Fed can get out of it, Danny, but it's complete with issues. The Fed, you know what the Fed can do, Daniel, to take down rates without doing anything policy-wise.
Inflation, you mean? Take down inflation?
Yeah, take down inflation, yeah, which will take down rates, which is what you want. You want the rates to come down, right? You want interest rates or yields to come down. Because really, Daniel, what I'm going to drive at is once you
got to raise rates to kill inflation first. You got to raise rates.
Oh, hold on, my friend. What happens if they taper? Look at that look, Don. That's exactly why I come here. I come here for that. That's exactly why I do this show. So what happens if they taper? And by the way, they really didn't get a chance to really taper because the market threw such a fit.
Taper tantrum.
Yes. Now let me show you this period in time, friends. And so what we're going to do here on Think or Swim is what you do is you go to time frame. I'm going to go to custom. I'm going to take this. We'll do 2014, the whole year, 2014, and then I'm going to just change this to 2015, and I'm going to hit OK. And then we're going to leave it on, we're going to change the ticker up here to SPX. So I'm starting here at the beginning of 2014. If you'll excuse me, this is still SPX. And this, my friends, is January 2014. And you can see it's a good market, right? A little bit of a correction pullback. But look, the market's generally going up. You get a little talk of tapering, nothing too much here in the August time frame. But look at this. Look at what's going on. There was something going on, Daniel, in this specific September timeframe. And what was going on are two things. One, you were about to introduce a tremendous amount of supply into the stock market in terms of the biggest IPO at the time, Alibaba. So Alibaba was coming into play, but then Ben Bernanke said, hey, we're going to taper. We need to taper. Danny, what does tapering do?
Well, it raises rates because the Fed was artificially keeping rates down by buying bonds.
Simple answer. Simple answer. You're
buying bonds to keep rates down.
You're buying, but you're stopping the buying of bonds. But let me show you something.
Meaning when they were going to
taper the bond buying program.
That's all. Taper the bond buyings, which will leave it to the open market and less demand.
Okay. Pause. Just These are like one word. Let me show you. Let me show you how the show works today, Daniel. One, get in and get out. Get in and get out, because I gotta get this out of here so I can then get your full analysis at the end of it. Okay. So let me show you. Let's see here. Securities held by the Fed overnight. And this chart that you're looking at, so you can see that we didn't really have a bond buying program here in 2012, 2013. Danny, look at this. We had a bond buying program. Look at that. Do you see that big old spike in assets held overnight by the Fed?
That's the balance sheet, the Fed's balance sheet.
Yep. So now look at 2014, 07, 2015, 01. So you're right in the time where the Fed says, Bernanke comes out and says, I'm going to taper. By this chart, we didn't do anything. Okay, we didn't do
all lip service.
Okay, pause. Don't. Not enough commentary right now. But watch what happens to. We're going to taper, and what happens to the market. By the time you hit the bottom, you've corrected almost 10%. That 9.54 number you see there is the percentage drop from that point right there in time to the end by the middle of the month. And then it's a V-shaped recovery because we're not going to taper, but let me just fast forward here a little.
I changed my mind.
Changed my mind, but but did I really? One more drop. No, we can't raise rates. We can't raise rates. Then the Fed finally figures out in here that they can't raise rates because what the market did was threw a fit. So your toddler is on the floor just rolling. I've got experience with this. Just rolling around, screaming about old bloody murder. It doesn't even matter. Like, you took his Pop-Tart away. He really wanted Pop-Tarts. So the kid's in a tantrum. Then you kind of got things calmed down, right, Daniel? Things are starting to calm down. We're back. We're good. Everything's good. No. And then you're going to throw a few more fits until we get the Fed to finally commit. Okay, we are not going to taper. As a matter of fact, look, let me show you. Let me just prove to you. We're not doing anything. I swear to God, we're not going to do anything. And so the Fed didn't taper at all. But yet you got that 10% dip in the market and then multiple retests or trying to retest those lows. Okay. So if the Fed, let me just show you this next chart right here. So I'll get these marks off of here, come back to my charts. Let me show you in the same time what TNX did when the Fed said they were going to taper. Now, keep in mind, I've got a chart here that starts, pardon me, TNX is the yields of the 10-year Treasury, and I'm going to stop messing up that chart right there, and I'm going to get my marker engaged down here. That's January, and then look at what yields did or rates did when the Fed, they were up here with the market, and then when the Fed said they were going to taper, the yields actually dropped, Daniel. Yields actually dropped, and then look at what happens. Let's control C that. Let's control X that. Get rid of that. Look at what happened to TLT in the exact same time frame. So we're starting with bonds over here on the far left. January, bond prices climbing, bond prices climbing. They fall as the market's going up, and rates, of course, are going higher. And then Fed says taper, market says no, and look at what you do here. You start a run in bonds that starts, if you cross the mean here, you're starting around 120 and you're going up to just under 140. That is a move, my friends, in bonds. And so it's my belief right now, and I've got more here to cover, that if the Fed says taper, you want to buy bonds, which is counterintuitive, Daniel. But there's a little bit of history right here that it's going to have the exact opposite effect. That the Fed doesn't have to raise interest rates to get inflation to drop. They can just drop the market. And if they drop the market, that should stave down some things. But I don't think that's what the effect you want to have, right? Because our entire confidence in our retirement system is based on the SPX chart, you know, the S&P 500 chart going from the lower left to the upper right, because we're not although we have social nets in this country, they're not the same. Don, can you move your camera down just a little bit? I just see your, I was getting your nose and upper lip.
Yeah, I'm in Pennsylvania. I don't have access to all of the bells and whistles that I used to have, but
I can see your whole head.
try to. Well, now I'm gonna have to maintain good posture the whole time.
Good luck.
It's gonna get a booster seat.
Sit up,
Yeah.
keep it that straight. Just remember what your mom told you in 4th grade.
Right now, my feet are dangling off the chair now.
No slouching.
So that's tapering, right? And that's bonds. So now, but let me show you a different chart set here. Let me just take you to something else. So Daniel, the whole inflation thing. So you can try to attack inflation by taking the market down and cooling it by just saying the word taper. You don't have to taper. You just taper, or you say the word taper. You don't have to do it. You can float that out there, and it'll most likely be a repeat of 2014 into 2015, 4th quarter 2014 into 2015. But what happens if, you know, we talked about this last week, that you increase the money supply, right? There's a huge M2, it's called M2. The Fed has been increasing the money supply to inflate the economy and get consumerism going, right, Daniel? Like, that's the whole reason behind the stimulus. And I would say, based on inflationary reaction, like the price of commodities right now, coupled with the pandemic, which is coming to an end, but you just can't spit out all the brick that's needed right now to build homes. People aren't moving. There's a whole host of issues going on, coupled with the tariffs. So what if you just reduce the monetary supply? What effect is that going to have? So let me show you this chart. So now let's go to the monetary supply. Let me show you what I'm looking at here. The Fed has been increasing the monetary supply. Here's a chart that goes to 05, right? And through 09. But if 2015, right here, 2015, 2014. So 2014, in that time frame, they've been increasing this monetary supply the entire time. The monetary supply never really dipped. It dipped for a little bit, and that little dip right in here, Danny, this little, you see, they're so minute. When the Fed did have a minor pullback in the money supply, what do you think happened to the market? Yep, it pulled back. Because, well, why would it pull back? And it's easier if I just show you this. So you could just look. I like to show the things that I use to construct the show, so you can go back and reconstruct it yourself. But look at this. All things being equal, the money supply lowers interest rates, which is what you want, Daniel. You want, even though rates are really low right now historically, I think you got to get the word historical out of your mind, because if you do, then you realize that rates going, as Danny has pointed out numerous times on the show, that rates going up to just 4.5% to 5%. I think, and I agree with Daniel here, would be equivalent to Carter's and Reagan's early years of 20 to 18%, right? Like when they peaked at 20%. Is a 5% interest rate in this country right now at this point in time, with the money supply as loose as it is that enough? Is that equivalent to Ronald Reagan when he took office, or the end of Carter's term? Is that equivalent to the interest rates? And so what you need to see here, folks, is that it makes it less expensive for consumers to borrow, right? When you have a larger money supply. Conversely, a smaller money supply tends to raise rates. So we can't, Danny, we in this country right now cannot decrease the money supply. If we decrease the money supply, it has the exact opposite effect of what we want. So right now we have an inflationary problem because there's too many dollars chasing too few goods. And when is the SEC?
Fix is to keep printing more money, keep it loose, and cause higher inflation?
Well, we're going to get there. We're going to get there. So I think Elon Musk is, and I think he is purposely manipulating the crypto markets. I think Elon Musk is wicked smart. I don't think anyone disagrees with that. And, well, you might disagree with it. You might think he's dumb. I don't know. But him causing dips in Bitcoin and Ethereum, especially Ethereum, which is I think is going to 10,000. And him causing dips in Doge, which is just funny because it's not real, but it doesn't mean it doesn't go up, is giving him an opportunity to buy the dips. I think you'll see my prediction for the rest of 2021 is the SEC sends him a sternly written letter saying stop manipulating the crypto markets. But the reason why there's an increase in asset prices is because cash is an ice cube melting on a hot summer day. You don't want to be in cash. They keep increasing the supply in cash. You want to be in something where it's supply limited or there's demand for the product that the moment it gets supply, it gets bought up. Hence lumber, hence brick, hence sugar, hence corn, hence soybeans, hence sports cards, hence everything. So they can't decrease the money. So if they try to decrease the money supply, Danny, to raise rates, like why would they, Tim, why are you even talking about this? Well, we know that if you raise rates, that decreases inflation too, right, Daniel? That's what Volcker did.
Yes.
Can you surmise what Paul Volcker did to crush crippling inflation at the end of the 70s?
Rates very, very high because they had to crush runaway inflation. So he took
Right.
rates up 6, 8, 10% very quickly so that they could, because inflation was out of control. It was double digit.
Mm-hmm.
By the way, when you had that high inflation, bonds lost 35% of their value. Treasury bonds.
Mm-hmm. Let's go here.
That's different than 2014.
So two key lessons, by the way, this is from the St. Louis Fed here. So two key lessons from great inflation era remain relevant to today. Great inflation show that tolerating high levels of inflation in an effort to stimulate the economy would ultimately prove detrimental. We, my friends, are in this right now. Like it's the people are just they've walked into the stadium, they've gotten their food, they're watching the game. It's like the bottom of the second. Like like you've got a couple batters that have taken a swing here. We're in early innings of this. Like if nothing is done, letting the economy run hot will ultimately end disastrously. I'm going to show you a different chart here in a second to kind of make my point. But I think it's equally wrong when you see historically rates are low. That's like when, so I'm trying to think of a good analogy. If you have one, anybody jump in here. But when someone tells you back in my day, gas costs a nickel a gallon, well, that doesn't help me now. Like back in my day, a burger was only 50 cents. And like, well, okay, great. But how does that help me now? Saying interest rates are low versus their historics, there's too much money in the system. To get back to historic rates, you would take away 90% of the money supply, Daniel? Like, and what are you going to do? Like, we've inflated so much.
So first of all,
Hold on, that wasn't really your entry. I'm sorry. I should give you better.
Going. Come on, baby. I'm up the bat. I'm ready to go.
I'm a bad teammate here. Let me set you up for a little bit more here, and it's going to make. So we've got that. We've got expansionary monetary policy here. So increasing the money supply is mirrored by an equal input to gross domestic product. If we take away the money supply, what do you think happens? What do you think happens? You take away the money supply. Yeah, you raise rates.
That's not real GDP. That's inflated GDP. But go ahead.
So now let me show you this. So I'm going to take this to January 1st, 1981. What was interesting about 1981, Daniel?
Around, well, it depends on which bonds, but around 17%.
Well, what was more interesting is that's when Reagan got inaugurated. And so I'm going to see if the TLT didn't exist. SPX existed. Let me make sure I got my chart here. So what you're looking at, friends, is a chart of the S&P 500. Okay, you can see the price scale on the right-hand side here. You got a chart of the S&P 500 from January 1st, and we're on a daily chart, and you can just see the price declines. Like you had some fits and starts in there, but it wasn't until, here's 1981, here's the end of 82, when Volcker peaked his rates in the 82 year from like 15 to 20%. He kept raising rates, right, Daniel? To stave off inflation. And it's a mistake. I'm going to keep repeating this because I think this is the point to drive home. It's a mistake to say versus historics, These are two completely different time frames. To say it's different this time is wrong. I think raising rates is going to absolutely destroy the market to stave off inflation. But what do you do to get rates to come down? You either say taper, or you actually stop. If you stop actually buying bonds, that's probably even worse than what happened. That was just a 10% blip in 2014, 2015. That's no big deal. This right here, though, I mean, when you look at January 1st, and I'll see if I can do this, January 1st to you finally sunk is a 25% decrease for the SPX. And someone's going, yeah, but you had some moves up in there. Sure you did, but that is a trend lower, my friends. And so how do you get out of this? What do you have to do? I think you got to get rid of these tariffs is what you have to, that's part of the solution, I believe. But if you keep on the path that you're going, and then your only answer is to raise rates, and you know it's reaching a fever pitch when a guy like Steve Leisman from CNBC is saying, we got to stop buying bonds. There's no need to be there's no need for the Fed to be in there buying bonds right now. Like the economy is quote unquote running hot. And if it is, and they keep doing this path, they've got the inflation they need. Now it's time to let the market see what it wants to do. You're going to get a correction. Either scenario, I believe, ends in a correction for the markets. And you could have had, we'll see, you could be on the path to a multi-quarter top in the markets, and it started this past week. Daniel.
Dan, I got a question. Back in the early 80s when Reagan got into office, did he lower taxes?
Once he got it through.
Yeah, he got them through in 82. And
do you think that's a reason also that the markets started to track higher?
Look, I'll go over a little historical stuff. So the primary reason the markets had a huge rally, in fact, it was the longest bull market in the history of the stock market, going back all the way to the 1700s, from 1981 all the way to 2000. Now, yeah, there was a crash of 87 that dropped 22% in one day, but the market was back even by the end of the year. So if you don't count that crash of 87, technically it was a a bear, because it dropped 20% or more. But it was because interest rates went from 18% all the way down to 6 or 7. Dropping interest rates are good. Companies are more profitable. Bonds go up. It was a bull market in both bonds and stocks. In the 70s, you had high inflation. Commodities and precious metals were the only game in town. Both bonds and stocks got hammered. So stocks lost 60% of their value, inflation adjusted, from 70 to 80. Okay, bonds lost 40%, 50%. They got creamed. Inflation is insidious, and it's worse than rising rates. So
what about taxes at the time?
Let me repeat that. Forget about
taxes go down, or
forget about, yes, but that helped. That helped. But when you're coming out of a massive inflationary cycle, okay, now people felt like it was out of control. They felt richer because their house had doubled in value, although it didn't create any more economic value. You just had more money printed. So in a very, very good, stable economy, you want to have a stable currency that the government can manipulate. You won't have these boom and bust cycles. The Fed actually caused these boom and bust cycles, and then we want to fix it with more printing. Now, when Tim was talking about 2014, all they had to do was talk about taper. They just talked about it and the market sold off. So, I mean, the market, but he said bonds went up right then. Well, it sold off immediately at first, but then everybody, money managers, was looking at the money supply, looking at the Fed thing where Tim's looking at, and they said, wait a minute, they're lying. The free reserves, the excess reserves in the liquidity in the banking supply, they're not pulling it out. They're not, quote, really tapering. They said they were, but they weren't. So the way that you know the Fed's lying or not, because a lot of times they are, they say, oh, we're going to pull money out of the economy, or we're going to raise rates, when they're actually flooding the market with the economy. Sometimes they're doing what they say they're doing, and other times they're bull-faced lying. And Tim's right. They'll try to talk down the market to just kind of not get it overheated. Now, here's the problem with today.
Can I pause you for 1 second? Because I think it's important. They're going to talk down the market because it's a way to get new policy through without doing anything.
Well, that's true. That's true. But
I want people to understand that at home.
Right. No, I get it. But here now, they're true. And I talked about this way back in 2008. Once you start the money printing and you start putting fake money into the economy, funny money, you can't turn it around because leverage works both ways. That's why I don't care what they're saying now. They can't taper if they want to, because if they raise rates, think about this, just 2%, our deficits, because the interest expense we pay on treasury bonds goes up hundreds of billions of dollars. So they can't try to stave off inflation now if they wanted to. Back in the 70s, they didn't have a $20 trillion deficit debt.
Right.
But now, hang on, let me finish. No.
Okay.
You had your turn, it's my turn. All right, now, so back in 2014, when Tim talked about them talking about tapering, they really didn't have to, but they didn't have inflation concerns. Inflation heating up wasn't a problem. Now they've got an inflation problem, and they're not sure what to do with it because they really don't want to raise rates because that will kill the economy, but then so will inflation. They will both hurt the economy. Now, moderate inflation, 2, 3, 4, 5, 6%, a lot of companies, especially commodity type companies, they can pass on they do better. But at some point, inflation, you can't pass on the higher cost to consumers, so profits get squeezed. Inflation is kryptonite to bonds. And at these low interest rates, bonds will get crushed with inflation. Pull up that TLT chart, Tim. Look at what has happened in bonds just in the last little while, and that's because of these inflation concerns. So the Fed has a really tough problem. They want to act like they're the parent at home and that they're going to try to, keep inflation under control. But the problem is once the horse gets out of the barn, it's hard to control. So they're in a tough spot.
Right. Now, let me just pause you 1 second so we can make this super relevant for folks at home. So there's on this chart of TLT that Danny just asked me to bring up. Look at 2021. And so look at just bonds can't hold the mean and then they just break. This is when inflation, here is November, right? And you get into the middle of the month, President Biden gets elected, and this is the effect of inflation on bonds, or you could say bond prices going lower or yields going higher. And it's digging into these charts and all the work that I'm bringing to you pretty much the last 2 or 3 months, that there's a reason why I believe that the NASDAQ simply hasn't, even though it hit a high, hasn't really recovered in comparison to what? The Dow hasn't. It's been weaker than the Dow. It's been weaker than the S&Ps. And it's because you want to own stocks that can pass on their price hikes to consumers. And a lot of these companies in the NASDAQ simply can't do that, especially the NASDAQ 100, which the NQ represents. But if you need concrete or you need steel or you're a transportation company, you're passing that cost on to the person who needs to move those goods. But eventually the Fed will, something's going to happen where the Fed's going to get the market to think the economy is slowing by saying the word taper, and the market, everything ties together, folks, when I'm talking to you. So at the beginning of the show, I said I was talking about the market being a forward-looking vehicle by 6 to 8 months. This stuff isn't happening like in an instant in a vacuum. That pullback, even though it's not here, and what'll happen is people go on CNBC or Bloomberg or they'll go on FinTwit, which is the worst, and they'll start talking about, well, it's not here yet. Let's see what the market's looking forward to what could be, and it's pretty good at predicting the future. And so, where do you want to focus right now, market-wise? I think you want to watch a couple of charts. Doesn't mean you don't invest. Doesn't mean you don't trade. It just means that understanding where you are in time and space. So maybe you continuously buying the dip in Amazon, or pick another stock that's been getting crushed lately. DoorDash, I don't know why I think DoorDash.
It's been crushed.
DKNG, Penn Gaming, even though they're reopening stocks, the high valuation stocks are getting crushed. And think about Penn. It all kind of makes sense now that I'm thinking about it. Like, if you've got less money in your pocket in 6 to 8 months, where are you not doing? It's gambling. And well, maybe you are because you need more money and you're good at it. But I think this is all. I think this is all starting to. It's like the bottom. It's like the second inning of this whole thing. I think that the what we saw in March was like a preview. I think the pullback we saw this week was like it's coming, and we're probably in for a multi-quarter top here, and probably the third and fourth quarter will carry with itself a ton of pressure on the markets in terms of volatility, and so it'll be interesting to see. Danny, you had some other things to say about this. Go ahead.
Well, yeah, I did want to say, so if you're buying TLT, the Treasury bond, its average maturity is around 20 years or so.
Yep.
So if they're putting out a $4 trillion budget, and they're also, the Fed is printing money. That means in 10 or 20 years, you're going to get that principal back. Not necessarily it's ETF, but if you own outright bonds, how much is that going to be worth in inflated dollars down the road? It's going to be worth 20, 30% less. That's what the correction is about. People are going, look, these bonds aren't worth that in the future. That's why inflation is so insidious to bonds. So, but and the other thing is true. They could, with policies, hurt the economy to slow it, and then you actually curb inflation, not even by Fed jawboning about it. Fed could jawbone about it, or it could be bad policy. It could be a lot of things that actually slow the economy. So it could be either one, and that's why you got to follow the charts. But you got to separate a good company, an investment, from the stock price, from what the investment does, because a lot of times they won't jive with your logic, or your logic is right, but your timing is slightly off.
So look here on the left-hand side of the chart, 114 through 514 of 2015. And you can see when bond prices bottom, right when the Fed starts talking about, yeah, probably October 1st, we're going to taper. I think TLT is something you can absolutely watch here. If the Fed says taper, I think you're going to see bond prices jump. And I think that's the first tool in the Fed's toolbox to try to get inflation to come lower, because and the Fed always says we're waiting for more evidence, but it's late, right? Like they're just now talking about inflation, but Danny, inflation's been here. Like we've done that show, we've done chart after chart after chart of inflation.
Well, if they taper, it makes sense for bonds to rally, because it means they're going to raise interest rates. It's going to strengthen the dollar. You're not going to get paid off in inflated dollars. We're not going to keep continuing printing money.
So
now, I think
I wonder if TLT is kind of like the tell that if you saw this for some reason and it doesn't make sense at first, you're just watching charts of TLT, and we watch this stuff all the time. Before they announce, I always believe that somebody knows, and it's probably Goldman Sachs, that they're going to taper or they're going to do something, and I think you'll see it show up in the price of TLT. And I'm using TLT, not bond futures here, because everybody has access to TLT no matter what platform you use. You can just watch this. And if you saw TLT somehow like recover the mean on these ATR charts, and it kind of doesn't make sense. Oh, let me get it to where we're at right now. Let me take it off this time frame. And it doesn't make sense. Just remember that when you're trying to impart what Danny was saying, your sensibilities to the market, just know that there's something happening in the background that you're not privy to, and things always make sense in hindsight, but they typically rarely make sense in the moment. And so when Danny says something like follow the charts, just having a little bit of historical precedence to understand that the Fed doesn't have to change monetary policy to get the desired effect that they want. And so that's point one. And so by just saying the word taper, they will manipulate rates, bond prices, and the dollar. And that'll all have an effect on the markets. And I think you'll see a pretty swift 10% correction in stocks. And then the market will try to figure it out from there. And so doesn't mean that bond prices going up are bad for the markets. It just means that the market's going to try to figure it out. And so it'll be really interesting. 2021, man, it's a more interesting year in the markets, I think, than even 2020 was.
Real quick, one of my mentors when I was very, very young, first in the business, 30 plus years ago, when I first came on board, and we actually did this called the money game. It was this money game that we actually followed the Fed and the free reserves for 30 years. Anyway, he said, you know what? The Fed doesn't give a blank about the stock market. It only cares about the bond market. The Fed cares. Now that's changed a little bit over time because
Right.
of people in 401ks, but they really do. The interest rates and the bonds are what they care about most about.
Yep.
That's what they're laser focused on.
Gotcha. Well, I'll tell you what, let's do this. I think that's a lot of economic information. I think it's relevant. I wouldn't do it if I didn't think it's relevant, but I think that's a lot to digest. Let me just show you something, folks. So if you go to the webinar, not the webinar, well, Don's got a webinar coming up. So if you go to the webinars tab, sign up for Don's webinar. Don, when's your webinar?
I have to delay it by a week because I'm up in Pennsylvania, but it is going to be June 2nd.
Okay, so I didn't mean to plug it here, but since I clicked wrong, let's just plug it right now. June 2nd is Don's webinar. If you've signed up in the past, you'll get it delivered automatically. If you want to join live, ask Don questions. Send Don questions now, Don at Revere Asset. Things you want to ask Don about. He will incorporate charts and all his research into there. But I was really trying to click on the podcast tab. And so really, I think this was the show that sets up the show you're listening to right now. And then Bitcoin and Ethereum did go on to hit highs, I believe, after this show. But that's not a bad one either, because it talks about the dollar and inflation and its effects. But I think that is a very good primer. But let's do this. Let's get into some research. Think about big pullbacks in markets this week, and big for this market, not overall. And when you look at the S&P's nice 2-day rally here back to the mean. But where is the path forward? And so, Hunter, you got some research, brother?
I do. And I want to read something off to you all here that might give you flashbacks to January of this year. I was just going through, I've got a list of about 1,400 stocks that I track across all sectors and industry groups. And I just want to read you guys some of the best price performers of the day.
Mm-hmm.
Farfetch, Riot Blockchain, Fubo, Skills, Blink Charging, Futu, Grow Generation, Jumia, Plug Power, NanoX, Palantir, DraftKings, Snow. So a lot of those stocks that have been absolutely obliterated,
yep,
whether they have merit and it's actually a changing character or not, are having a really strong day today. And a lot of those charts are still really broken. But it's interesting to see, because we really haven't seen it where those stocks are the ones that are really outperforming. And a lot of those have actually pretty solid volume. You could say maybe it's shorts covering after, or booking gains after really doing well with these stocks getting hammered. But I just thought that was interesting as I was scrolling through here. But let me get to the research. So I got just a couple of names here, and I want to start with two that I've been talking about for a while. NUE, Nucor, massive run up to 100, but it's actually holding up relatively well after that move, and just kind of sitting right there at 100, only up a little bit today. And STLD is similar, and both of these were actually red this morning and are now green. I say that STLD is still slightly down, but holding up relatively well after a strong move. The only thing I want to say here is keep your eye on this group, and particularly these two names, because they're the strongest. To your points about if it continues, these are two names that are poised to benefit. They benefit from a weaker dollar as well. So, and that's reflected in the stock price. So just two names to keep an eye on. They are extended, but they're holding relatively well after a really strong move. Kind of to continue in the same theme, I'm watching FCX very closely here. It had a reversal a few days ago after it ran up to about 46, 47 or so. Let's see here. I'm trying to get the high from 510, $46.10. And it's kind of, pulling back to the 21. It's almost there. It's still about 4 or 5% above it. And you showed the chart of copper has also taken a little bit of a breather, but not quite back to the mean yet. But just one I'm watching possibly for an entry off the 21. It's one we've traded successfully over the past 6 months, and it's been one of the strongest stocks in the market. So one that you certainly don't want to take off your radar. And the chart looks incredibly healthy and attractive right now, just waiting on the right time. Another name that I don't think I've ever mentioned on the show, I covered it last night in the video, OC, Owens Corning. This is a building stock, a different way, to play that space, but it had as as the home builders did, as a lot of the materials companies did, et cetera, had a rough day on the 12th. Owens Corning was down 5.5%, but came back with a nice bounce off of the 21, continuing that today. And one of the stronger charts as well, just holding up really well. Go ahead.
Hunter, do you know who the Pink Panther is?
Like the cartoon?
Yeah, like the cartoon.
Yeah, yeah.
Like that has got to be Owens Corning employs they license the Pink Panther. That's got to be the smartest marketing campaign. I'm trying to think of one better than, I mean, insulation is a commoditized product. It all does the same thing pretty much. I'm quite sure there's different quality variants. I don't know insulation, but let's just pretend that insulation is all the same no matter what you buy. And then to make theirs pink, and then to run marketing with the Pink Panther, the fact that I remember that like what 30 years later, like it stands out. Like I don't know if it drives more sales, but you got to pay for those commercials with something. And so
I'd love to know how they arrived at that marketing strategy. Like, let's get this cartoon, and then let's also make our materials pink.
Yeah,
like, oh, yeah, that sounds great.
Sellers that were hilarious. Big Panther.
But it's interesting that they still use it to this day. You know, like what did the folks from asbestos do all those years? No, we're not going to kill you. I saw an ad the other day. I don't know if it was on Twitter or scrolling through something where it was the doctor's choice, Camel cigarettes.
The doctor's choice.
The doctor's choice.
I saw that too on Twitter.
Oh, it's Twitter. Okay.
It was like back when coffee and eggs were bad for you and doctors smoked cigarettes.
Thank you.
Something like that.
So it was Twitter. Yeah, like how interesting is like to justify like doctors selling their soul, you know, like come on, surely they do, right? Like drink this mercury. It's gonna they used to drink shit like that. Like mercury will cure anything. Just drink it, and before you know it, you're just poisoned. Can't figure out why. Like thank God. But what is the thing today that people are endorsing that we're going to find out 50 years from now it's just going to absolutely kill part of the population? Is it the COVID vaccine? Did not mean to start a hot topic there.
Just throw a grenade in the room, Tim.
It's going to be like the mesothelioma thing. Did you receive the Johnson & Johnson vaccine? You could be entitled to a settlement.
That's got to be starting right now. Did you get AstraZeneca?
They're indemnified, man. Congress wrote a law. They're completely indemnified.
Are they indemnified?
Yes. That's how you know it can't be as safe as they're saying, because they got indemnified, every one of them. So you can't do anything if you have a bad outcome.
The Texas Hammer can't go after these people. There's they're on TV, folks. The Texas Hammer. I don't know if y'all ever saw.
Completely indemnified.
Really? Well, then there's got to be something that's going to kill. It's okay, here it is. It's 5-hour energy drink. 20 years from now, they're not going to sell. Yep, they're not going to sell 5-hour energy drink, and you're going to see those commercials with, and there's going to be lawsuits against whatever in 5-hour energy.
And there'll be those plastic particles too, in certain types of plastic.
Oh, hell yeah!
Plastic? Have you ever used plastic?
I would lean more towards Four Locos.
That's how they're going to kill the petroleum. Petroleum will survive on plastics till they kill that as well. Absolutely. What are going to be the new containers? Like, are we all going to just walk around with cork flasks?
Can't be wood.
Did you say give me wood? Is that what you just said?
And it can't be wood. It's too expensive. It can't be wood.
Oh, it can't be wood. It's too expensive. I asked a legitimate question there because I wasn't sure what. Look at House going. I thought that's what he said too, but I didn't want to say it out loud.
All right, let's get back to Hunter and the stocks. Let's move back on.
I've just got one more individual stock, WAL, Western Alliance Bancorp. We currently have Goldman Sachs, which has been one of the better performing big banks. This is a smaller bank that was one of the leaders, and it still is. It's just consolidating here right at the 100 level after a nice move following earnings. It really didn't follow through like you'd want it to, but nothing wrong with the way that it's acting here. It's almost came down and touched the 50-day moving average twice now. Now it's trying to stay above the 21-day exponential. Just one worth watching, one that's been on our radar as well.
Can I just dovetail onto your any bank trade? If the Fed said taper, if you remember, if rates go lower, you're absolutely going to see the bank trade get crushed. If the Fed just whispers taper, like the bank trade is done for the time being. I do not think you'll see. You know what? Why guess, Danny? Why sit here and declare some kind of proclamation? Why don't we just go back in time and look at it?
Charts. Follow
On the charts. Yeah, let's do that right now. Let's do the taper tantrum real quick, because now I'm curious, because I actually don't know, because the show is planned by me, but the fellows don't really know what I want to talk about. Let's see. Danny's laughing because it's completely true, but that's how we keep the spontaneity going. It's how we keep the marriage alive. It's the elixir to good sex in a long-term marriage. Don't tell them what's coming.
Okay.
I'm pretty sure that analogy worked, right?
Perfectly.
Perfectly.
Let's look at Citigroup, and then we'll look at Bank of America. So, like, take.
I was going to ask how you keep it interesting with Tanya, but no, I'm scared.
Not gonna go there.
No, I'm not going to go there. I'm afraid what'll come out of your mouth.
And if I said like Michael Scott, that's what she said, I think we've nailed the joke and the dismount.
There you go.
All right, so here we go. Let me get to the taper time frame of the show. Let's see, September into, boy, bank, they had a good year. Citigroup had a great year. And then look at this, there's the middle of September. So that was a pullback. Oh, you can't see that. Let me just do it from the other direction. You're looking at a pullback of about 10% with the markets, 10 to 11%. So let's do Goldman Sachs, because not all banks are created equal, Tim. You got to do like for like. Okay, I'll do it. Don't worry. Here we go. Middle of September.
Same, it looks like.
Yeah, about the same. So I down about 9%. Getting crushed in this market is so many different things. Like S&Ps really didn't have that big of a sell-off, but I mean, stocks just fell out of bed. And these SPACs have fallen out of bed. Like the high valuation stocks, man, are just not, they're not recovering. Like you mentioned a couple there that are having really good days today, and they're just not gonna get crushed into oblivion. I mean, I hear there's good support for Civic at 0. Like Nikola has a really good trend line at 0. And so let's pull up, what's Nikola doing these days?
You're getting all kinds of articles now beating up Kathy Wood, asking if she's just a charlatan or a really good investor.
Oh, it won't even let me pull up. I'm in the wrong time frame. No, that's why, because Nikola didn't exist. I'm like, why won't I pull up the chart? Nikola. This is just a brutal chart. What was this before, Don? Before it was Nikola? Don traded it really well.
Not with a T. I remember.
You remember what it was called, Don? It was.
I don't.
You traded it before it actually became the SPAC, or the former, before it was Nikola. I forget what it was, but for that 93 right there. That's so reminiscent of what's the pot Tilray? What's Tilray doing these days?
Tilray actually merged with Aurora Cannabis to form the largest weed conglomerate company in the world, or they're in the process of that merger.
I mean, that is just destruction, right? Like that's nuts.
That's a Reddit pump in the middle there, isn't it?
They got
big spike up.
They got the big pump in the same time that GME and all that stuff was going crazy. Tilray, I think Tilray was the main.
You can't get married to a theme. It's like the 3D stuff.
Yep. Boy, that's brutal. Oh, you know what? I apologize, Don. I know what you're talking. I didn't realize I was still in this year. Hold on. That's why I'm like, wait a minute. I thought that was the, I can't pull the chart back when it was, remember, didn't this go to 300? I thought I was looking at the 300 price spike.
It's like September 2018, I think.
Yeah, this chart is not accurate, because Tilray, I thought, had gone up to that 300 price spike.
Let me see what I can pull up. Yeah, it was right after they IPO'd.
So bottom line, it was at 300 and now it's at 13. 14.
Yeah, Chipotle, CG. Boy, Chipotle would just go off this. If you could get your food and your pot at the same place, like get a bowl and a bowl, a bowl and a bomb.
Probably coming.
Chipotle would 3 burritos, not 1.
Yeah.
Good for business.
Very good for business. Now, look at this chart, but man, I do like me some Chipotle. What's Chipotle?
Don, I want to know what 300 down to 14 is. 13.
That would be
Percentage
about
wise?
a 97, 95% fall.
Danny, they call that a divorce where I'm from.
Yeah, about a 95, 96%.
All the
drawdown
spice
from the
won't,
all-time
all the
highs.
spice in your marriage won't work when you lose 95%.
That's
Well,
exactly right.
on
What you
Tilray
got?
was $4 for a long time. So Tilray actually was down 99% from all-time highs for quite some time.
It's on sale. When you hear someone say things on sale, it just cringes. Like, you're getting the stock on sale, man. Ain't no sales in the stock market. If people have got their garbage out, there's a good chance you don't want it. What you got, Alex?
I'll make it short and sweet. Just two names, TJX.
Oh, I love me some TJ Maxx.
Alluding to the inflation play that you guys were talking about. This could work
Why?
during
Tell me why.
inflationary
Why could
period.
it work?
Retail has a history of retail stocks generally do well during inflationary periods. Especially like a discount retailer like TJ Maxx and Marshalls, what have you, because they own Marshalls. There's several companies you can check out on their website. The other company I mentioned in my video was WPM, Wheaton Precious Metals.
Oh yeah, let's take a look at it.
It just broke out above its 208. I had sold it during this week when the markets were really coming in. I wasn't sure, but I may buy this back because it's above the 200-day, and that theme is working. I still have gold, which is Barrick Gold. That one's working out, but otherwise, I did a lot of profit taking. I haven't bought stuff back. I'm waiting for the NASDAQ or the QQQs to get back above the 326 level. I think, Don, you mentioned that level was important. So we'll I'm not jumping. I'm holding back. I may be wrong. If I'm doing that, I'm not buying stocks right now, then maybe the viewers should be buying because I may be wrong.
Sure. All right, Mr. Don, webinar June 2nd.
Yep, process improvements is the title. Going back doing a deep dive of the growth stock sell-off that has hit us in-house here, and a bunch of lessons learned to take away from that.
I'm sorry, let me fix my charts, Don, before you give me some things you're looking at. Don's going to do the 21 over 20. You got the video tonight, Don, right?
Yep.
Okay, so 21 over 21, if you want to start your weekend research, go to reviewasset.com, Daily Market Insight. What you'll do is you click on that link and you will get Don's watch list 21 over 21, right, it'll be right somewhere in here, Friday evening, maybe like 5 or 6 o'clock Eastern Standard Time. Go ahead, Don, what you got chart-wise?
Let's take a look at something that we took a position in today, Yeti. Specialty retail has been doing pretty well, and especially with the open up, people wanting to get outside. This is a stock that has very strong brand awareness. People are very dedicated to it when they get one. Yeti had a very nice shakeout on earnings yesterday, pulled all the way back down to the 50-day moving average, which also coincided with the prior breakout area. Anytime you see double support like that holds, it's a good sign. Their sales and their earnings were very strong, so that immediately gets it on our radar. You always wonder how things are going to report, and then of course you wonder about the reaction. The initial reaction was down, but buyers came in, and then today a day two higher high is always something that I look for after an inflection point. The inflection point in this case being earnings. So it got back above the 21, and volume is still there today on it. So nice low risk entry back above the 21 with a stop below today's low. Should hold. That today's low also corresponds with the low from before the shakeout and the prior week. So there's a lot of support in the 83 and change area. So that would actually a little bit higher up. I'm not going to go back down that far.
Oh,
so
sorry.
Move
Okay.
to the right, last week's lows.
Oh, right
there,
here.
There you go. Yeah.
Oh, gotcha. Thank you.
So take a position size so that if we get stopped out, we're limiting our losses in this market to shooting for no worse than 0.2% AUM. So for example, if we have a 4% size, that's a 5% loss. That's 0.2% AUM. The best trades always work right away. So if it doesn't work, we're getting out quickly. And also targeting, we're not waiting for 20% gains. Looking to take some profits a little bit quicker in some things. Market like this, where the indexes are fine but growth stocks aren't, really what we're looking to do is tread water, maintain even keel with the indexes until the environment gets better for growth stocks, because it absolutely isn't good for growth stocks right now. But that could change at any time. One of the first things that we want to look for is the index is getting back above the 21. That worked in the S&P today, also worked in the Dow. Got back above the 21. The NASDAQ 100 is right at 21, which is acting as resistance. But if it pokes its head back above it, that's a nice low risk entry. It should hold it. And if it doesn't, then that's the market telling us something. But growth and tech have been extremely weak, but harsh downtrends, just like strong uptrends, don't persist forever. We always got to be on the lookout to see when they're going to change.
All right, is that all you got until tonight's video?
Right. Yep. Check in. Be about eight or so stocks turning over the 21 over 21.
I got a quick question, because I actually got a live text while we're on the air, and someone that follows us pretty closely said, "What do y'all think of Coin and Baba?"
Oh,
And then in parentheses, my single largest position.
No and no.
What is his largest position?
Don, this is radio. You have to elaborate. You got to give a reason.
Coin is a broken IPO. We don't bottom fish.
Okay.
I mean, if you are a bottom fisher, yesterday's low, actually the low from last week, if you wanted to take a shot at it, but this is just garbage. They brought it in too high. They brought it live too high at the IPO, and it immediately sold off. And now you just really wait for it to form a base. The first spot I would look to get into it is the couple of rallies over the last 2 weeks. It poked its head right above 300 and got rejected. If it pokes above 300 and it sticks, that's the first place that I would look to be possibly taking a position in this. And that's Coin. Baba has been one of the weakest China stocks since Jack Ma got in trouble for his comments about Ant Financial and the Chinese government. Anything that's under the 200-day moving average is just an avoid. And this is trending lower, can't get back above the declining 50-day moving average. And again, we don't bottom fish. This is at 208. This is at like lows going all the way back to June of last year. And knowing what the markets have done, this is just not. This is not the pond that we fish in.
They call that not good. Daniel, let's do this. I've got one last thing, but let's do the normal outro. I'll get you set up for it. Go ahead.
Folks, listen, if you like what you heard, please tell a friend, tell a neighbor, send them to revereasset.com, and they can go to subscribe, and they can sign up for our daily market insight video. One of those gentlemen above, you can see there, will be doing it. They alternate, and it's anywhere from 8 minutes on, depending on how inspired they are. It's good research. It's for educational purposes. If you want specific investment advice, reach out to me, Dan at revereasset.com. You can always call us old school at 855-REAL-WEALTH. Now, don't forget, Don moved his lunch and learn to June 2nd. He was going to do it the week before, but he's got some commitments. He can't do it. So it's going to be June 2nd back in his massive trading room. And if you want to sign up for that, you can just go to webinars right there, Tim's got, and you can sign up for that. Even if you can't sign up even if you can't watch it live, where you can do Q&A, he will send you he'll send you the recorded link. And that's a webinar that's Wednesday at noon. It's live during market hours. So it really can help you. If you can reach out to any of us with questions, Dan@revereasset.com, Tim, Hunter, Alex, or Don at revereasset.com.
So one last thing before we go, fellas. So people, FinTwit's notorious for this, always talk about shorting. Seems like I pick up a lot of people talking about shorting. Shorting looks easy in hindsight. It's really difficult. You got to nail your spots. It's incredibly, incredibly difficult. And oftentimes it's better to just let well enough alone and just wait for your pitch onto the long side. But let me show you Penn here. Hunter brought Penn up, or we were talking about it, and I remind myself I wanted to talk about this with folks. There's the mean, or the 21 exponential moving average on my charts here. And then you can see over the last 21 days what Penn has done. That's not relevant here per se. What the 21 gives you, and I'll just put 21 right here. If you were to get 2 closes below the 21, that typically starts a shift in trend. I use the word typically because there's no absolutes, but that's your shorting. And then, well, where do you take profits at? Well, you could take profits at 1 ATR to the downside, or 2 ATR if you're going to trail up your stop. But once you're out, the re-shorting point is the mean. And you can see Penn has struggled to just get above the mean. It's all easy in hindsight. But now Don mentioned we'll use SPY or SPX today. SPX, let's say that you took the same trade, the same short, and look, you got a couple closes here below the 21. So let's say that you saw the closes below the 21, or the mean as we call it here in the shop, and you decided to short it, but now it's back above the 21. Just get out. That's the signal that you're wrong. Like you don't have to have a thesis. You don't have to have a theory. Well, Tim, you just spent like a half an hour talking about inflation, and we're all going to hell in a handbasket. That's cost more than it did last year, hence the handbasket cost. So just get out. Like today at 12:19 Central, you would be wrong to be short the S&Ps. And these are just binary decisions, like ones and zeros. Like when I type on my computer, it's a series of ones and zeros, yes or no, yes or no. And right now it's no, don't short the SPX. It's not, if you're in there, get out. It's a trade that's not working. And then my favorite chart right now is gold. And doesn't mean it's going to be the most bountiful or the best chart. It's just, even though it's off the mean, this consolidation in gold looks like it wants to come up and try to get up to that third ATR. And that third ATR is up here about 1870. And so about 50 points higher, 30 to 50 points higher from where it is. I mean, we're playing hand grenades, not horseshoes here. So I like this chart of gold a ton. And I don't even want to lump it in with inflation and gold fights inflation. I just like that chart setup. And so
Hey, Tim.
Go ahead.
You know how you mentioned ABBV was your pick for the year?
Hmm?
I really like that name, but I was on the gold topic theme-wise, and I hate doing this, and I know you said the same thing, but if we're going to do this, that's my pick for the year.
Yeah, like gold, I think is it's not going to be a fast trade. It's just something I really like here. And then I like I think the industrials are just, I mean, they're unrelenting.
Yep.
I mean, they're just, I mean, you got some relief here to maybe try to buy, but this is XLI, so you can look at the stocks that make it up, but you want to buy. I think you want to, I mean, again, if you want advice, because this video isn't advice, it's for edification purposes, call Danny wherever he's at on your screen right there, 855-732-5932. But this chart right here is just, it comes up into the zone of the ATR and gives you a chance, and it gave you a chance here. But I think it's something that you want to look at when it does dip. And the Fed's going to, I think the Fed's going to do something, but you just can't say, well, Tim thinks it's going to do something or Danny thinks it's going to do something. You got to let the charts play out the way they want. But I like gold and I like industrials. I think those are the trades. And then, of course, Alex, people getting injected with Botox because everyone's on video. And guys
what chart-wise on ABBV, what caught your eye?
Oh,
I'm curious to see what your thoughts were.
That was 3 weeks ago. So let's get it. Let's do a weekly. Show you on the weekly. So this is I'm not on. Okay, now I've got it on a weekly.
There you go.
So 3 weeks ago, 1, 2, 3. It was above the 21 weekly, but if you go to the daily,
Is
I
that a
like the
cut?
consolidation. Eh,
It's
could have
not
been.
deep enough, is it?
Flat
But it was
base.
it came
Yeah.
3 weeks ago. You're right here in that zone of the 21 after earnings, and then just a pattern I look for.
I think it's a really good idea.
Yeah, people realize when you look like Vern Lundquist, which I know does not improve. Mark from Buffalo texted me after the Vern Lundquist joke on the ABBV. He loves Vern Lundquist, says I was screwing with the legend, and it's bad karma. So
Has he ever listened to him call a football game? I mean,
Oh,
I know he's a golf. Mark from Buffalo likes golf, and I know Vern Lundquist is a golf commentating legend. But
right.
I've watched a lot of SEC football, and I watch Vern Lundquist on mute. So
According to me, mommy, you were watching the
Hunter.
What
wrong
don't you
team.
like about Vern Lundquist?
everything.
Whoa.
I'm
narrows it down.
expecting.
We
I'm
don't
expecting
care
hate
what you
mail.
think, Hunter. Does Meemaw like him?
That I don't know. My
She doesn't like
presumption
being
would
called
be no.
Meemaw for one thing.
It's
me
me, mommy. Danny, hold on. I know what happened there. Danny was thinking hee-haw. He got confused.
Wow.
Yeehaw,
Wow.
yeehaw. It all flows.
I know. I know how Danny's brain works.
Gloom,
Danny,
despair,
it's
and
me,
agony
mommy.
on me.
Gee, so
I'm gonna
but
swim
you're
in the
watching the
cement
wrong
pond.
team. You should be watching Auburn, right?
She is a big Auburn fan. She loves Cam Newton and she loves Auburn.
Who called that big field goal block run back for a touchdown? Was that Vern?
I don't think it was Vern. I don't
He
know
must know
who,
he
but
had him on mute.
Who replaced Vern?
I know it's still
Gary Danielson is
Gary Danielson. I'm trying to think of it's not. I don't know who it is. I'm only thinking of NFL commentators in my head right now. Not Nessler, is it? Is it Brad Nessler?
Oh, is it Brad Nessler? I think it is Brad Nessler. Oh, yeah, I think it is Brad Nessler. That's a lot of the older broadcasters, it's hard. Like you got to know to prepare for a broadcast like that, you got to know so much. And they have a lot of help, but still, it's a lot to keep up there. Marv Albert is starting to lose. If anyone's heard Marv Albert call a game recently, just with different names getting mixed.
That is Vern Lundquist too. I equally hate him. So hopefully Mark doesn't love him too, because then we're just really.
I think Mark is sending in a letter right as we speak. So you're going to get a strongly worded letter from Mark from Buffalo. So with that, Danny, take us home.
We'll talk to you next week on Your Money.